Hello friends, welcome. Friends, as you know that I am in the process of working my website and I'm going to announce the opening of my website very soon. While I was working my website, I have uploaded this chart. So this chart looks something like this. Okay. So this is an heat map where multiple charts are overlapped on top of each other vertically. So you can see that there is one metric here, there is one metric here, and then there is another metric which is laid out here, right? So I'm going to explain to you why I am discussing this chart in this video and what kind of insights that you will be able to get by looking at this chart. Now when you go to my website, you will see something like this. There is a heading and a short description, and then there is one link here which you can click, where you can get the demo how to use this chart. Now, the reason I'm discussing this chart right now is because of the event which took place yesterday, where Federal Reserve of US announced rate cut by 0.25 basis points. So this is a second cut. Now, if you look at this chart, you will notice a very interesting kind of insight by looking at these three parameters which are sandwiched on top of each other. What are these parameters? One is the US inflation rate here, another is the US policy rate, and then the US bond rates of different duration here. These are all heat maps superimposed on each other with respect to a certain time metrics, right? It's a time series. Now let's go step by step and try to understand what insights you will be able to see in this chart and why this chart is very important and useful. First is that let's talk about the color scheme of this heat map. You know how you read the color. The intensity of the color is as the intensity of the value of the particular metric becomes higher, you will see green, you will see red color, and the green means of lower intensity. So if you look at this part of this chart, you will see that this is basically giving you inflation. So you can see that inflation was low in March 2021 at 2.62%, and then it went high, and now it is tapering down. Can you see that from June 2023 till November? So November number and October number is extrapolation because these numbers are not yet announced. So I just extrapolated them. But even if you consider up to September 24th number, which is 2.41%, you can see that the general index or inflation rate of US is coming down. But the policy rates, which were low initially when the inflation was high, has slowly increased even during the time the inflation fell. You can see there is a phase lag between the inflation going very high and the policy rates which were held very high. At the time when the inflation was high, the policy rates were low. Can you see that? For a certain duration, maybe around 70% of the time, the policy rates were low. So there is a clear-cut phase lag between the policy rate being increased and the inflation increasing in real time. This is the real inflation. Now there are two types of inflation. Let's talk about that. This is the real CPI inflation, and then there is an expected inflation. Now what is from where the expected inflation is coming? The expected inflation can be clearly seen from the bond rate of higher duration, 10-year, 20-year, 30-year. So this is where the expected inflation. If the yield is higher, means the expected inflation is higher. Why? The reason is that the higher duration bonds yield is not controlled by the US policy rates, cannot be controlled because these are short-term rates. This will only influence the bonds which are of short-term duration, not of higher duration, and the higher duration bonds are controlled by the expected inflation of the individual investing in the market. The reason is that if, let's say, if you are expecting a higher inflation during a period of 10 years, you will definitely not invest in a bond which is going to give you a lower yield because you will lose money, right? As simple as that. Therefore, these are all market determined rates, so you will tend to invest in a higher yield bond, or the bonds should give you a higher yield in order for you to beat the inflation. As simple as that, and that is why this is going to show you it is a direct indicator of expected inflation. Now let's look at a very interesting factor here which comes out from this chart. You can see that at the time when the real inflation was high, the expected inflation on the bond yields were in green. Can you see that? Almost 50% of the time, the expected inflation, the bond yield was green. So what I basically am trying to tell you is that as the real inflation went very high, the expected inflation got directly impacted. So real inflation has got direct implication on expected inflation because there is a direct phase lag between the expected inflation, which is the bond yield, and the real inflation, because as the real inflation increased, the expected inflation also increased because you can see the higher duration bond yield started increasing. Now, why I am telling you all this? The reason I am telling you all this is that the policy rate, the increasing of policy rate is done with a purpose to cool down the market, to lower the inflation. That's the only simple objective, because you control liquidity, you contain demand, and if you contain demand, the prices prices goes down, and the inflation gets contained. That's the whole purpose. Now you can see that the policy rates were held high till September when they started reducing. Now let me, before I tell you, when you look at this chart, these are monthly averages, and these are monthly averages of the last time unit that you choose. For example, if you choose month, then whatever rates that you see here, all monthly average. Suppose, let's say, if you choose quarter, then the last month of the quarter average is what will going to get displayed here. If you choose year, then the last month of the year, the financial year, because I'm basically taking Indian financial year, though it is US follow a different norm, is going to be displayed here. So there will be a slight difference between what for example, the policy rates have been set lower here. It is 4.90. What was the rate? Let me just have a look at it. So it is now has been cooled down to Federal rate lower the fund rate, interest rate now range from 4.75 to 4.75, right? So that's the rate. But here you will see the numbers are different. It's slightly higher. The reason is that it is an average rate, right? That is what I wanted to say. Because 4.9 for this month of October, the full month it was 4.9, therefore it was 4.9. Okay, but here it went to 4.75. I think 4.65. Yeah, but it is still showing higher because it is a monthly average. That's a distinction that you have to make here. Now, what you see here, that the policy rates have been held high. You can see that the policy rates have been held high till month of September. You can see month of September it was held high to till 5.20, and then from October it started tapering down. But the biggest issue that I see here, where I have a problem, is that the expected inflation is still held very high. But there is a positive or a silver lining here. What is the silver lining? As I told you, that there is always going to be a phase lag between the real inflation and the expected inflation. I am hoping that as the real inflation goes down, these numbers are going to taper down, because there will be a direct bearing on the real inflation, direct bearing of expected inflation with the real inflation. So it is very clear now why Fed is able to lower rates. This is no magic. You can clearly see from this chart. If you look at this chart, you can clearly see that the real inflation is going down, but the expected inflation is still held very high because of this phase lag. Can you see here? Because of this phase lag. So it is expected that as the real inflation stays low, then you can see green as you go forward in time on the higher side, because the most important factor which matters in an economy is expected inflation, not real inflation. Because expected inflation which drives behavior of the individual. For example, if I am a worker and if I am expecting a higher inflation, I will demand more wages. If I am a factory owner manufacturing products, and if I am expecting higher inflation, I will demand higher prices. So expected inflation is what drives behavior of the people. Real inflation is just a number. It's a symptom, right? So looking at what the real numbers are, the expected inflation is going to get driven. So the Fed, making changes in the policy rate is not a surprise. It is clear that there has been a certain period of duration where the inflation has been held low, and Fed is expecting that the bond yields are going to go low because of this phase lag, which you can clearly see from here. And that is why this chart is very important. You have to look at this chart, you have to monitor this chart, because these three metrics are overlaid on top of each other. So what you can do here, you can here, you can do multiple things. There are multiple controls here. You can actually go back in time by 10 time units, right? So if I go back in time by 10 time units, you can see 10 months I go back, and you can clearly see that the inflation was very low during this time frame, right? From May 20, the inflation was low. Can you see that? Inflation was low and expected inflation was low. And the real inflation rose, and it kind of, the expected inflation held low because people did not digest the inflation, and then the expected inflation started rising because the bond yields were started rising, which had a spiral bound impact on the real inflation. And that is why the Fed has to control. Fed was raising the rates because they wanted to control the real inflation, so that the expected inflation went down, because the economy gets negatively impacted because of the expected inflation. Everything is going to get disturbed if the expected inflation stays very high. And that is simple macroeconomic principle which I wanted to explain through this chart. There is one more chart here for India version which also tells a similar story, but the video is getting very long. As my website is going to get launched, you can basically use this chart on a active basis, because you can choose, like for example, if you can choose rural inflation, you can choose urban inflation, you can choose general index, you can choose all kinds of control inflation that you want to choose. You can overlay on top of Indian bond yields, and you can go down back in time. So this is a very powerful chart, because you will never see these kind of charts which are openly in public. Took me a lot of time to process this data and create these charts. Okay, so there are many such charts in my website. Once the website gets up, launched formally, you will be able to use this chart, and you yourself can draw many conclusions, because simple statement does not mean anything, right? These headlines do not mean anything unless you look back in time, in past, and is using the past, you can able to predict the future. So thanks friends for your time, and I still do not have much time to record video, write articles, because my website is taking a lot of time. It will take another 20 days before I will be able to launch my website. Thank you very much friends. I'll come back with a new video next time.